Question 1. An individual buys a 10-year level term life insurance policy. What does level refer to in this context? A. The premium payments remain the same throughout the policy term. B. The cash value accumulates at a constant rate over the policy term. C. The death benefit remains constant over the policy term. D. The policy can be converted to permanent insurance at a level rate. Answer: C. The death benefit remains constant over the policy term. In a level term life insurance policy, the level refers specifically to the death benefit, which means the amount of coverage paid to the beneficiary if the insured dies remains the same throughout the entire policy term. This provides consistent protection for a defined period, allowing the policy owner to know exactly how much coverage they have. For example, a $250,000, 10-year level term policy will pay $250,000 if the insured dies at any point within those 10 years. Remember that while premiums often also remain level for term policies, the primary meaning of level term specifically relates to the death benefit amount. Question 2. Which life insurance policy type builds cash value and provides a death benefit that can remain in force for the insured's entire life, assuming premiums are paid? A. Annually renewable term. B. Decreasing term. C. Whole life. D. Universal term. Answer: C. Whole life. Whole life insurance is a type of permanent life insurance that provides coverage for the entire life of the insured, as long as premiums are paid or the policy is paid up. A key characteristic of whole life policies is their ability to build cash value, which grows over time on a tax-deferred basis and can be accessed by the policy owner through loans or withdrawals. This combination of lifelong coverage and cash value accumulation distinguishes it from term insurance, which provides coverage for a specific period without building significant cash value. Think of whole life as permanent coverage with a savings component. Question 3. What is the primary purpose of the Medical Information Bureau, MIB? A. To perform medical examinations for life insurance applicants. B. To act as a central clearinghouse for individual medical records. C. To assist insurers in risk assessment and prevent fraud by sharing medical impairments. D. To provide health insurance claims data to providers. Answer: C. To assist insurers in risk assessment and prevent fraud by sharing medical impairments. The Medical Information Bureau, MIB, is a non-profit association that collects and shares coded information about an individual's past health conditions or medical impairments reported during previous insurance applications. Its primary purpose is to help insurance companies verify information provided by applicants and to detect misrepresentations or fraud during the underwriting process, thereby preventing adverse selection. For example, if an applicant fails to disclose a serious heart condition, the MIB might have a record of it from a prior application, alerting the new insurer. Remember, the MIB does not store actual medical records but rather codes that indicate certain health findings. Question 4. In a life insurance policy, who has the right to exercise all policy ownership rights, such as naming beneficiaries or taking loans? A. The insured. B. The beneficiary. C. The policy owner. D. The underwriter. Answer: C. The policy owner. The policy owner is the individual or entity who possesses all contractual rights and controls over a life insurance policy, including the ability to name or change beneficiaries, take out policy loans, assign policy rights, or surrender the policy for its cash value. While the insured is the person whose life is covered by the policy and the beneficiary is the person who receives the death benefit, it is the policy owner who holds these significant decision-making powers. For instance, if a parent buys a policy on their child's life, the parent is typically the policy owner and controls the policy, not the child, the insured. Always remember the owner holds the control. Question 5. Which of the following policy provisions prevents an insurer from denying a claim due to misstatements made in the application after a specified period, usually 2 years, from the policy's issue date? A. Grace period. B. Free look provision. C. Incontestability clause. D. Reinstatement provision. Answer: C. Incontestability clause. The incontestability clause is a vital life insurance provision that limits the insurer's right to void a policy due to material misrepresentations or omissions in the application after the policy has been in force for a specific period, typically 2 years. This clause protects the policy owner and beneficiary by ensuring that, after this period, the policy cannot be cancelled by the insurer, even if minor inaccuracies are later discovered, with the exception of fraud in some states. For example, if an insured incorrectly stated their height by an inch, after 2 years, the insurer generally cannot deny a claim based on that misstatement. This clause provides a sense of security that the policy will indeed pay out when needed. Question 6. A life insurance policy's cash value growth is generally A. Taxable annually as it accumulates. B. Subject to capital gains tax upon policy surrender. C. Tax deferred, meaning taxes are postponed until the cash value is surrendered or withdrawn. D. Fully tax exempt, never subject to taxation. Answer: C. Tax deferred, meaning taxes are postponed until the cash value is surrendered or withdrawn. The cash value growth within a permanent life insurance policy, such as whole life or universal life, is generally tax deferred, meaning the accumulated interest and earnings are not taxed annually as they grow. Taxes are only applied when the policy is surrendered, and the cash value received exceeds the premiums paid, or when withdrawals are taken that exceed the policy's cost basis. This tax advantage makes cash value life insurance an attractive savings vehicle for many individuals. Think of it like a 401k or IRA, where earnings grow without current taxation. Question 7. All of the following are typically considered non-forfeiture options in a whole life insurance policy, except A. Cash surrender value. B. Extended term option. C. Reduced paid-up option. D. Automatic premium loan. Answer: D. Automatic premium loan. Non-forfeiture options are benefits available to the policy owner if they stop paying premiums on a permanent life insurance policy that has accumulated cash value, ensuring they don't forfeit the value built up. The 3 standard non-forfeiture options are cash surrender value, extended term, and reduced paid-up insurance. The automatic premium loan is a policy rider or provision that allows the insurer to automatically pay an overdue premium from the policy's cash value to prevent it from lapsing, but it is not considered a non-forfeiture option itself. Remember, non-forfeiture options are what you can choose when you stop paying. Question 8. What is the primary purpose of the free look, or right to examine, provision in a life insurance policy? A. To allow the insurer to re-evaluate the policy terms within a specified period. B. To give the policy owner a specified period, e.g., 10 days, to review the policy and return it for a full refund if not satisfied. C. To permit the insured to consult with a medical professional before accepting the policy. D. To enable the beneficiary to review the policy terms before a claim is paid. Answer: B. To give the policy owner a specified period, e.g., 10 days, to review the policy and return it for a full refund if not satisfied. The free look provision, also known as the right to examine, gives the policy owner a specific number of days, usually 10 or more, starting from the date the policy is delivered, to review the policy and decide if they want to keep it. If the policy owner is not satisfied for any reason, they can return the policy to the insurer for a full refund of all premiums paid. This provision ensures consumer protection by allowing careful consideration without financial penalty. For example, if you receive a policy and realize it doesn't match what you understood, the free look period lets you cancel risk-free. Question 9. Which rider provides for the waiver of premium if the insured becomes totally disabled, allowing the policy to remain in force without further premium payments? A. Guaranteed insurability rider. B. Accidental death benefit rider. C. Waiver of premium rider. D. Payor Benefit rider. Answer, C. Waiver of Premium rider. The Waiver of Premium rider is a valuable addition to a life insurance policy that protects the policy owner if the insured becomes totally and permanently disabled. If this condition is met, the rider waives all future premium payments for the duration of the disability, ensuring the policy remains in force and its benefits, including cash value growth and death benefit, continue as if premiums were being paid. This rider provides crucial financial relief during a time of hardship. Imagine being unable to work due to a severe injury. This rider ensures your life insurance coverage isn't jeopardized by missed payments. Question 10. When a life insurance policy is assigned absolutely, what happens to the policy rights? A. Only a portion of the policy's cash value is transferred. B. The policy owner retains all rights, but the beneficiary receives the death benefit. C. All policy ownership rights are permanently transferred to a new owner. D. The assignment is temporary and automatically reverts to the original owner after a specified period. Answer, C. All policy ownership rights are permanently transferred to a new owner. An absolute assignment of a life insurance policy involves the complete and permanent transfer of all policy ownership rights from the current policy owner to a new owner. This means the original owner gives up all control, including the right to name beneficiaries, take loans, or surrender the policy. For example, a business owner might absolutely assign a policy to a bank as collateral for a loan, giving the bank full control of the policy. Contrast this with a collateral assignment, which is a temporary transfer of rights, typically as security for a debt, and reverts once the debt is paid. Question 11. Which settlement option provides for the proceeds to be paid out in a series of equal installments for a specified period of time, regardless of the beneficiary's survival? A. Life income option. B. Interest-only option. C. Fixed period option. D. Fixed amount option. Answer, C. Fixed period option. The fixed period option, also known as installment for a specific period, is a life insurance settlement option where the death benefit proceeds are paid out in equal installments over a predetermined number of years. If the beneficiary dies before all installments are paid, the remaining payments typically continue to a contingent beneficiary. This option provides a predictable income stream for a set duration, which can be useful for beneficiaries who need income to cover specific expenses over time, such as funding a child's education for 10 years. Question 12. A policy owner makes a one-time lump sum payment to fully pay for a whole life insurance policy. What type of policy is this? A. Limited pay whole life. B. Single premium whole life. C. Universal life. D. Endowment policy. Answer, B. Single premium whole life. A single premium whole life, SPWL, policy is a type of whole life insurance where the entire premium for the policy is paid in one large, lump sum payment at the time of purchase. This results in immediate cash value accumulation and a fully paid-up policy from the outset, providing lifelong coverage without any further premium obligations. This option is often attractive to individuals who have a substantial amount of available cash and wish to leverage the policy's immediate cash value growth and tax advantages. It essentially front-loads all the premiums. Question 13. What is the primary characteristic of an annuity's accumulation period? A. The period during which the annuitant receives income payments. B. The period during which the annuity owner makes payments into the annuity and the value grows. C. The period after annuitization when interest continues to accrue. D. The period when the annuity is irrevocably converted to a death benefit. Answer, B. The period during which the annuity owner makes payments into the annuity and the value grows. The accumulation period of an annuity is the phase during which the annuity owner contributes money, either through single or periodic payments, into the annuity contract, and the invested funds grow on a tax-deferred basis, typically through interest or investment gains. This period precedes the annuitization phase, where income payments begin. For instance, if you purchase an annuity at age 40 and plan to start receiving income at age 65, the 25 years in between represent the accumulation period. This is the growth stage where your money is building up. Question 14. Which of the following statements regarding the tax treatment of life insurance death benefits is generally true? A. Death benefits are typically taxable income to the beneficiary. B. Death benefits are generally received income tax-free by the beneficiary. C. Death benefits are considered taxable income if they exceed a certain threshold. D. Death benefits are only taxable if the policy was purchased within 2 years of death. Answer: B. Death benefits are generally received income tax-free by the beneficiary. One of the most significant tax advantages of life insurance is that the death benefit paid to the beneficiary upon the insured's death is generally received income tax-free, according to current tax laws. This means the beneficiary does not have to pay federal income tax on the amount they receive. This tax-free payout makes life insurance a highly effective tool for providing financial security to loved ones. For example, a $500,000 death benefit would be received by the beneficiary as the full $500,000, without income tax deductions. Question 15. What is the purpose of the Fair Credit Reporting Act, FCRA, in relation to insurance underwriting? A. To prevent discrimination in underwriting based on race or religion. B. To ensure that applicants are treated fairly regarding information collected from third-party sources. C. To regulate the advertising of insurance products to consumers. D. To establish minimum capital requirements for insurance companies. Answer: B. To ensure that applicants are treated fairly regarding information collected from third-party sources. The Fair Credit Reporting Act, FCRA, is a federal law designed to promote the accuracy, fairness, and privacy of information contained in the files of consumer reporting agencies. In the context of insurance, it protects consumers by ensuring that if an insurer obtains a consumer report, such as a credit report or MIB report, during the underwriting process, the applicant is informed of this and has the right to dispute inaccurate information. This helps maintain the integrity and fairness of the data used in risk assessment. Essentially, it gives you rights regarding your financial and medical data when it's used for insurance decisions. Question 16. An insured individual has a life insurance policy with a Payor Benefit rider. What does this rider provide? A. It pays an income to the insured if they become disabled. B. It waives premiums if the policy owner, who is often a parent, becomes disabled or dies. C. It allows the policy owner to purchase additional coverage without proof of insurability. D. It provides an accelerated death benefit if the insured becomes terminally ill. Answer: B. It waives premiums if the policy owner, who is often a parent, becomes disabled or dies. The Payor Benefit rider is specifically designed for policies insuring a minor's life, where the policy owner is typically a parent or guardian. This rider stipulates that if the payer, the policy owner, becomes totally and permanently disabled or dies before the insured child reaches a certain age, usually 21 or 25, the premiums on the child's policy will be waived until the child reaches that age or the disability ends. This ensures the child's policy remains in force even if the person responsible for payments can no longer make them. It protects the policy for the child's future. Question 17. Which life insurance policy allows the policy owner to adjust the death benefit and premium payments, offering flexibility based on changing needs? A. Traditional whole life. B. Limited pay whole life. C. Universal life. D. Endowment policy. Answer: C. Universal life. Universal life, UL, insurance is a flexible type of permanent life insurance that allows the policy owner to adjust both the death benefit amount and the premium payments, within certain limits, after the policy is issued. This unbundling of the mortality, expense, and cash value components gives policy owners greater control to adapt their coverage as their financial circumstances or needs change. For instance, if you need to reduce premiums for a period due to financial strain, universal life offers that flexibility, unlike traditional whole life. Question 18. What is the primary difference between a fixed annuity and a variable annuity? A. Fixed annuities offer tax-deferred growth, while variable annuities do not. B. Fixed annuities have guaranteed interest rates and principal, while variable annuities' values fluctuate with underlying investments. C. Fixed annuities are regulated by FINRA, while variable annuities are not. D. Fixed annuities are used for retirement income, while variable annuities are for immediate consumption. Answer: B. Fixed annuities have guaranteed interest rates and principal, while variable annuities' values fluctuate with underlying investments. The primary distinction between fixed and variable annuities lies in how their cash values grow and how income payments are determined. A fixed annuity offers guaranteed interest rates and a guaranteed principal, providing predictable growth and income, making it less risky. In contrast, a variable annuity's cash value and future income payments fluctuate based on the performance of underlying investment options, separate accounts, which carries investment risk but also offers potential for higher returns. If you prefer stability and guarantees, a fixed annuity is suitable. If you seek growth potential and can tolerate risk, a variable annuity might be chosen. Question 19. An insured has a life insurance policy with a revocable beneficiary designation. What does this mean? A. The beneficiary cannot be changed under any circumstances. B. The beneficiary must consent to any policy changes. C. The policy owner can change the beneficiary at any time without the beneficiary's consent. D. The beneficiary receives the death benefit only if they survive the insured by a specific period. Answer: C. The policy owner can change the beneficiary at any time without the beneficiary's consent. A revocable beneficiary designation grants the policy owner the full right to change the named beneficiary at any time without requiring the beneficiary's consent. This offers maximum flexibility to the policy owner, allowing them to adapt their beneficiary designations as life circumstances change, such as divorce or remarriage. Conversely, an irrevocable beneficiary would require the beneficiary's written consent for any changes. If your financial situation or family structure changes, having a revocable beneficiary allows you to easily update your wishes. Question 20. Which life insurance dividend option allows the policy owner to use the dividends to purchase a small amount of additional paid-up insurance? A. Cash payment. B. Reduction of premiums. C. Accumulate at interest. D. Paid-up additions. Answer: D. Paid-up additions. The paid-up additions dividend option uses the policy's annual dividends to purchase small, single-premium whole life policies that are entirely paid for and add to the policy's death benefit and cash value. These additions generate their own dividends, which further enhances growth. This option is popular for those who want to maximize their policy's long-term value and increase their death benefit over time without paying additional out-of-pocket premiums. Think of it as continuously buying tiny, fully paid-up life insurance policies with your dividends. Question 21. What is the primary purpose of the cost of living (COL) rider in a life insurance policy? A. To increase the policy's cash value to keep pace with inflation. B. To automatically increase the death benefit to keep pace with inflation without proof of insurability. C. To adjust the premium payments based on the Consumer Price Index. D. To provide coverage for medical expenses related to inflation-adjusted healthcare costs. Answer: B. To automatically increase the death benefit to keep pace with inflation without proof of insurability. The cost of living (COL) rider is designed to help maintain the purchasing power of a life insurance policy's death benefit by automatically increasing the death benefit amount in accordance with increases in the Consumer Price Index (CPI), typically without requiring the insured to provide evidence of insurability. This rider helps protect the beneficiary's future financial security from the eroding effects of inflation. For instance, if inflation is 3%, the death benefit might increase by that percentage annually to ensure its real value remains stable over time. Question 22. In life insurance, what does insurable interest mean? A. The policy owner has a personal or financial stake in the continued life of the insured. B. The insured has a valuable asset that can be used as collateral for the policy. C. The beneficiary has a legally recognized claim to the death benefit. D. The insurer has a financial interest in the policy's premium payments. Answer: A. The policy owner has a personal or financial stake in the continued life of the insured. Insurable interest is a fundamental principle in insurance, meaning that at the time the policy is issued, the policy owner must have a legitimate financial or emotional stake in the continued life of the insured, such that they would suffer a financial loss or emotional distress if the insured were to die. Without insurable interest, an insurance contract is generally considered a wagering contract and would be void. Common examples include spouses, close family members, or business partners. This ensures that insurance is used for protection against loss, not for speculative gain. Question 23. What is the main characteristic of a decreasing term life insurance policy? A. The premium decreases over the policy term. B. The cash value decreases over the policy term. C. The death benefit decreases over the policy term. D. The policy's term length decreases over time. Answer: C. The death benefit decreases over the policy term. A decreasing term life insurance policy is characterized by a death benefit that gradually decreases over the policy's term, while the premiums typically remain level. This type of policy is often used to cover a specific declining financial obligation, such as a mortgage or a loan, where the amount of protection needed reduces over time. For example, as your mortgage balance decreases, so does the amount of coverage needed, making a decreasing term policy a cost-effective solution for that specific debt. Question 24. What is the entire contract provision in a life insurance policy? A. It states that only the policy document itself constitutes the entire agreement between the insurer and the policy owner. B. It outlines all riders and endorsements that are attached to the policy. C. It specifies that the policy application and the policy document together form the entire contract. D. It refers to the legal standard for all insurance contracts in a given state. Answer: C. It specifies that the policy application and the policy document together form the entire contract. The entire contract provision in a life insurance policy legally states that the policy document itself, along with a copy of the original application, including any riders or endorsements, constitute the complete agreement between the policy owner and the insurer. This provision is crucial because it ensures that no statements or agreements made outside of these documents are legally binding, protecting both parties by defining the definitive terms of the contract. It means everything you need to know about your policy's legal terms is contained within these specific papers. Question 25. Which of the following best describes the per stirpes designation for beneficiaries? A. The death benefit is divided equally among all living primary beneficiaries. B. The death benefit is paid only if the primary beneficiary is alive at the time of the insured's death. C. The death benefit is distributed to an insured's living children, and if a child is deceased, their share passes to their descendants. D. The death benefit is paid to the closest living relative of the insured. Answer: C. The death benefit is distributed to an insured's living children, and if a child is deceased, their share passes to their descendants. The per stirpes, Latin for by branch, beneficiary designation ensures that if a named beneficiary predeceases the insured, that beneficiary's share of the death benefit will pass down to their living descendants, e.g., their children, rather than being divided among the other surviving named beneficiaries. This method ensures that family lines are protected. For example, if an insured names two children, A and B, as beneficiaries per stirpes, and child A dies before the insured but leaves two children, the insured's grandchildren, then B gets half, and A's two children split A's half.